Hi everyone. Had some interesting discussions today just in regards to stop losses. So thought I'd put together a quick video. So uh, basically, the trader was saying that he gets stopped out and then the trade plays out, and I'm sure a lot of traders can probably relate to that. So the first thing to understand about stop losses is that you need to know what range you are actually trading in. So if you don't know how to identify a range, there's videos on that. But I'll give you just a brief overview of it. So a range is going to be two or more candles of the same type going in the same direction. So basically, this blue one, this is a range. This yellow one, this is a range. Now, at the top of the blue ones and at the bottom of the yellow ones, we have break levels. So if you wanted to break the accumulation cycle or the buying power, you need to go down and close below the break level here. If you wanted to break the selling pressure of this range, you need to go above that break level there. So first you need to know what range are we in. So have we hit that break? No, we haven't. Have we hit this break? Yes, we have. So then where's our next break level? Well, from an accumulation perspective, it's going to be that range, these two candles here. And just for proving a bit of a point, there's our next one. And if we were to go even further down, there's our next one. So to the upside, right, what have we got? We've got that break level up there. Okay. And there's also one over here, which is a break origin level. But there's videos on those, etc. We won't bother too much about that right now. So if you're going to trade just in this two candle daily range here, and you're looking for, say, a short, the short is going to come somewhere when you get up into the hold candle. So the hold candle is the underside of the engulfment here. And the trade idea is that as the price comes up into the hold, its job is to keep the price ranging down. If the price gets to the break, that then is the first signal that it's breaking out of the downwards trend and it's looking to go up. So as far as where you would consider putting a stop loss, the first place you could consider is going to be above the break of the range. So if we put a stop loss just in here, above the break of the range, and it gets hit, well, there is a pretty good chance that the price was going to go up and therefore your short concept is invalidated. The only thing is that quite often, if your short is going to turn into the biggest short known to man, they will actually sweep the top of a range before they go down. So if we look over here as an example of how that plays out, we had this break level, we have this hold level. The hold level gets hit. So concept of I'm looking for a short in this area, that's a very smart concept. You should be looking for a short in that area. But if you had your break level stop loss set up here, you get stopped out and then the move continues. So there's a couple different types of stop losses. So I sort of call them hard stop losses and soft stop losses. A hard stop loss is where you actually set it on the exchange or the DEX and you get stopped out and then you are the trader messaging me going, I always get stopped out and then my trade turns into an epic trade, which I'm not in. And that's because they swept the liquidity from the top side of the range before they went on the short. So your idea was right. But the thing is, instead of getting a little short, they wanted a big short. They wanted to go down for many days. And that's why they swept that liquidity and came back under the range. So the true sign of breaking out of a range is when they close above the range. That's number one. Number two, when they hard close another candle of accumulation above the range. So it has to be like another yellow candle up here and then off it goes. So having a stop loss at the break level is one concept, but you might find that you do get stopped out and then you get a really big move. So the other type of concept is to have a soft stop loss. Now the risk with soft stop losses is if you get one of those epic big green candles and it just shoots off into the sky, well, you're going to lose a lot of money because you didn't have the stop loss there and it just took off. So the thing about a soft stop loss though, sorry, I don't think I was designed for YouTube videos, is that if it goes up and sweeps that liquidity and then comes back down and closes under the range break, well, you know you've got your trade and it's gonna then come down. So if you were to then think of, okay, well, where would the next place be? So if it sweeps the range liquidity for this range, chances are it's not going to sweep this range, which is quite a way out, up there at 219. So if you were to enter into this trade anywhere in this whole candle, which is sort of 195 up to 205, instead of having the stop loss sitting here just above the range break and getting stopped out, you would look to have it up here at about 219. So you've got to factor all of that in when working out your risk reward, the size of your position, the leverage that you use, because you have to allow for that stop loss to be all the way up here. Now, the other way you could look at doing this is to have a hard stop loss up there, which stops that $50 gold candle from wiping out your account. You could factor this into your risk, and you could actually look to enter some of your position in this hold candle and look to maybe average it out if it goes higher, or enter the other portion of the risk if it goes higher. So then if they do sweep the range liquidity, when they come back down, so if they close outside of the range, when they come back down to actually test the backside of the break here, you could actually look to exit your trade. And you might be able to get out of that in profit depending on how you average it in this gap up here. But as far as stop loss placements, if you're wondering why you often get stopped out, it's either because you've placed it in the range, and there was that the James Wynn guy who just kept on getting liquidated not so long ago. Every time he posted a trade up, his liquidation was inside the range. Now that's just crazy. You do that and you're going to get liquidated because that is where the price range is. So your stop loss would never ever be below the break. You would never have it below the break, because anywhere below the break is probably going to get hit, because that is where the price is ranging. If you go just above the first break, you might be a victim of a sweep like you would have been in this scenario up here. If you go up above the second break, then I guess the thing about that is you're going to be taking smaller trades because you've got to factor into the bigger distance as far as the risk. You might not be making as much in profit as far as risk reward goes, because maybe the short is not going to be as long. But if you did that, and let's look at it just in this particular instance here, if we had taken our short and we'd entered in this candle, so we're going to say, let's just say we got the worst entry. We took the absolute bottom of the candle, okay, and we put our stop loss all the way up here. And what we were aiming for is so let's see, where was the bottom of our range? Our range was down here. But we did have this hold candle right here. Now the hold candle can then reverse the price back up again. So you've got to be taking your first TP here into that hold candle. It's got to be first. So that's not a very good risk reward. And if you showed that to the average trader, they'd say that you're never going to last as a trader and you're going to get stopped out too much. And one stop out is going to be the death of two trades. And that's absolutely true, right? But the actual chance of that trade getting stopped out is really low. The win rate of doing that would be really high, and therefore the chance of you getting stopped out and losing the profit of two trades by one is really low. So that's option number one. Option number two is that you take 50% here and you bring your stop loss back down into profits. In which case, you got your 50% there, the price went back up here, and it's continuing down. So you could then look and go, okay, well, if the hold level's not going to hold, where do I take my next 50%? Well, I'm going to take it at the break level on the other side. And then suddenly your trade becomes a better trade. It doesn't become like a true one-to-one, because it wouldn't be, because you've taken half your profit off there versus the whole risk that you had when you're up there. But it becomes better. It becomes like a 0.75 trade. Now, if it hits this level down here, well, that's indicating that the price might want to therefore go lower. So you could look to take maybe another half again there. And then you say, well, where's my next hold level? Where's my next break level? Well, it's over here. So this is going to be, there'll be a hold level in this blue candle here. You could then continue to run that last little portion of your trade down to there. And you've got a pretty reasonable trade by that point. More of these will actually play out than you can imagine, because the structure and the way price moves around on charts is very, very consistent. It's just a case of, do they sweep it first, which is where those people get stopped out, because that's where they expect you to have your stop loss. You're saying, well, it's not going to go above the previous high. Well, that's why they'll go above the previous high before they take it down, because everybody thinks it's not going to go above the previous high. So it makes sense to stop people out there and then take all their money and then go. If you put it all the way up here, you got to take smaller trades. Yes, it doesn't fit within the conventional risk reward concepts that traders talk about, but the one of the things that always bugs me is that most traders lose. So why do the conventional concepts actually make sense if most traders lose? So you got to think outside of the square, because you just got to wonder, how many times do they want you to have it above this? Why are you told to put it above this? Well, that's because they can then take your stuff, sell into it up here. Yay, that's it's just crazy. Anywho, that's a little bit about stop losses. That's also probably a little bit about just trading in general. And I guess the one last thing I'll just touch on in this video is also consider the answer to getting a good trade is to take the greediest entry. And where would the greediest entry be? Well, it's not going to be the very bottom of the whole candle. It's going to be somewhere else up inside the whole candle. And I'll do another video on refining hold levels and how to find greedy entries. But in this case, it was actually the way to enter this trade really was to enter it when the candle closed back under the break level. You could have jumped into this trade knowing that it was a sweep of liquidity and now we're going to go down. That would be the really good way to do it. You could take some profit at the first hold level. You would put a stop at your entry, should be right here, and then you'd see how much more you could get out of the trade. So hopefully some people get something from that, and yeah, we'll keep these coming. Like and subscribe and all that stuff. I think we might have just had about 259 members. That's pretty damn awesome. And yeah, catch you later.